Hi, good morning, everyone. Thank you for joining us and tuning into this webinar. My name is Sharon Cornelissen, and I'm the Director of Housing at the Consumer Federation of America. Here at CFA, we are so pleased to be able to host the Coalition for Federal Home Loan Bank Reform. This group is emerging as a powerful voice to provide greater transparency into the home loan bank system, to aggregate relevant expertise and data, and to advocate for change. As you all know, last year, the Federal Housing Finance Agency, headed by Director Sandra Thompson, started a wide-ranging national discussion on the home loan bank system. And based on this year-long efforts, last month, FHFA published a report with key recommendations for reform, including both regulatory actions as well as changes that will require congressional approval. So in today's webinar, I will start us off with a basic kind of 20-minute primer on home loan banks. And then this overview will be followed with a conversation with two key experts who both bring decades of experience in housing finance and in GSE reform. Unfortunately, Reverend Luis Cortez could not make it today, but we will do with Peter Knight and Barry Zigas. I also would like to thank my CFA colleagues, Katie McCann and Anne-Marie Lowery, for making this webinar possible, alongside the support of fellow members of the Coalition for Federal Home Loan Bank Reform. We will leave plenty of time at the end for questions. So if you have a question, please type it in the chat function below. This webinar is being recorded and a recording will be posted online. All right, so let's get started on this primer. So what's the Federal Home Loan Bank System? The Home Loan Bank System is the largest US banking system that most Americans have never heard about. This is intentional, as of up to about a year ago, home loan banks had mostly kept kind of a low public profile. And as they act as a bank for banks and for insurance companies, they service financial institutions directly, rather than interacting with consumers. The home loan bank system was founded in 1932 in the midst of the Great Depression as a way to provide more liquidity for mortgage finance. The home loan banks made cheap loans to savings and loan banks at the time and insurance companies, for which they put up mortgages as collateral. So in effect, this cheap supply of liquidity stimulated the supply and the affordability of mortgages. So as the slide shows here, there are 11 regional branches today, and they collectively issue debt. And this makes the home loan bank system the second largest issuer of debt in the United States, coming only after the US Treasury. So initially, savings and loans, banks and insurance companies comprised the bulk of the membership, and this reflected who was doing mortgages in the 1930s, of course. But big changes were made after the collapse of the S&L industry, and in 1989, membership eligibility expanded to also include commercial banks and credit unions. And since 2008, community development financial institutions, also known as CDFIs, can also become members. So this chart shows the distribution of membership today. And we see, for instance, that just over half of members today are commercial banks, and 1 in 4 members are credit unions, with CDFIs comprising only 1% of current membership. So what do federal home loan banks do exactly? We can see them as a kind of bank for their members. They pass on government subsidies to their membership institutions in the form of cheap loans that are also called advances. And their membership institutions can use these below market rates loans as a source of liquidity for any of their banking activities. And in exchange for loans, members post collateral with the home loan banks in an amount that's determined based on the perceived risk of this exact collateral and of the perceived risk of the member institution. The most common collateral types include mortgage-backed securities, residential mortgages, and commercial real estate loans. Members are also required to be stockholders in the home loan bank system, and in return, they not only get access to these cheap advances, but they also get paid out dividends every year. And the lion's share of the net income that the home loan banks generate every year gets paid out as dividends back to the members. So home loan banks often like to compare themselves to private financial companies, and their views on what's appropriate executive compensation, bank structure, and the amount of affordable housing that they should support all flow from this kind of mindset of thinking of themselves as this private financial institution. But in fact, home loan banks are very different from large commercial banks, for instance. Most importantly, they are a government-sponsored enterprise, or a GSE. And as such, they enjoy many direct and indirect benefits from this status. This includes, for instance, a $4 billion Treasury line of credit. They are exempt from federal, states, and local taxes. They enjoy super lien status. This means that if a member financial institution fails, the home loan bank has first claim on the collateral that they posted and on other assets if needed, even before the FDIC and before taxpayers' claims. This also means that they run virtually no risk of losses because of this super lien. And all of this also results in what's called an implied guarantee on their debt. This means that buyers of home loan bank debt expect that the US government will not let this institution fail if it gets into trouble. And this came into play as recently as March of this year, when regional banks such as Silicon Valley Bank were failing, and indeed the home loan bank system got repaid by the FDIC. So this GSE status and the implied guarantee that this sort of comes with allows the system to borrow at much lower rates on the global capital markets as other institutions. So they pay at a cost close to what the US Treasury pays for debt. So this is a discount of around 50 basis points, or 0.5%, cheaper than large AAA rated financial institutions. So together, all these benefits and this discount on global capital markets result in an annual government subsidy of around $6 to $9 billion a year. So what do we get in return for this government subsidy? In fact, very, very little at this current moment. So today, the home loan banks have almost no discernible impact on affordable housing, despite, of course, their founding purpose as home loan banks. So many of their members are not even in the mortgage business anymore, despite benefiting from home loan bank advances. For example, a recent Bloomberg review of home loan banks found that over 45% of members had not originated a single mortgage in the last 5 years. So not a single mortgage. And over the last, part of this is because over the last decades, independent mortgage banks who are not home loan bank members have come to comprise the vast majority of mortgages. Also at this moment, there's no ongoing test to assess how financial institutions use their membership to support affordable housing and community development. So at this moment, home loan bank members can use advances for any purpose. So another way to look at this is to compare how much home loan banks contribute to affordable housing to the contributions of Fannie Mae and Freddie Mac. So, for example, in 2022, Fannie and Freddie together contributed more than $1.1 billion to the National Housing Trust Fund and the Capital Magnet Fund. And in that same year, home loan banks contributed only $267 million to their affordable housing programs. They are required to spend that amount of money. So by current statute, home loan banks are required to spend 10% of their net income every year to support the affordable housing programs, which is also known as AHP. As the graph here shows, home loan banks pay most of their, the lion's share of their net income to dividends every year. So we see them in blue in this graph, compared in yellow, a much smaller contribution to AHP. So we see that dividend payouts every year are much to their members, much exceed what they contribute to kind of this public purpose. But of course, we need so much more, given our deep affordable housing crisis today, in cities and communities all across the country. And also at this moment, most of the funds from the affordable housing programs offer kind of small gap financing contributions to large housing development projects. So they offer like small contributions to large housing development projects, while the bulk of these projects are financing with LIHTC funding and home funds, for instance. Home loan banks also often talk about that they do a lot of voluntary, what they call voluntary affordable housing programs. But when we kind of look deeper into that and did some research, we found that for most of these banks, these so-called voluntary programs were little more than a rounding error on top of the minimum of 10% AHP. So the table shows that in 22, system-wide, the banks only contributed 1.3% of their net income to voluntary affordable housing programs above the statutory minimum. So you can kind of see the variation in what different banks contributed. So, the need for home loan bank reform was recognized by a landmark report that the FHFA, the Federal Housing Finance Agency, published last month. You can find this exceptionally well-written and well-researched report online. And its recommendations broadly fall into 4 categories. So first of all, the report explains the mission of home loan banks, of the system. It calls to better define and clarify this mission as being not just about providing liquidity to members for any purpose, but rather to provide liquidity for housing and community development specifically. FHFA calls to realign the practices of home loan banks today with its central mission. Second, the report contains recommendations around safety and soundness. And this part of the report was prompted by the failing of large regional banks like Silicon Valley Bank and Signature Bank in early 2023. For example, the report notes that the Federal Reserve discount window should function as a lender of last resort for banks dealing with an acute liquidity crunch rather than the home loan bank system. That's not their function in sort of the broader housing finance system. So third, FHFA offers a host of regulatory and congressional recommendations for how home loan banks can better support affordable housing and community development. For example, the report recommends to at least double affordable housing program contributions from what currently stands at 10% to 20% or more, something that will need congressional action. The report also proposes an ongoing membership test to make sure that advances are more closely tied to housing and community development. And fourth, and finally, FHFA offers specific recommendations to improve home loan banks' operational efficiency, structure, and their governance. This includes the question of what number of home loan banks we need to kind of best support the system going forward, and how home loan banks can better share operational costs where it makes sense. The report also suggests that Congress give FHFA more authority to ensure that executive compensation is appropriate and consistent with a public mission. So what's at stake here, right? We have this legacy institution from the 1930s that has become a $1.6 trillion system. Nearly every bank and credit union across the country is a member, but over time, its impact on housing and community finance needs in almost all areas of the country has become very small and negligible. Of course, the system works very well for financial institution members who receive cheap loans that they can use for any purpose and also receive generous dividends on those loans. Financial institutions, financially profit from the status quo, right? So this is why they defend it. But the coalition maintains that the system is really strayed from its founding purpose to support housing and community development. As communities across the nation seek to build more affordable homes, finance local hospitals, or support community centers in rural and tribal areas, for instance, regional home loan banks should be true partners and help drive these key investments, rather than only offer some tiny gap financing or impose barriers to access. So 2023 is looking to become one of the most profitable years in the history of home loan banks, with an expected $7 billion in profits. This is equal to the entire federal spending in 2023 for community development block grants and homeless assistance grants. However, as it stands, only 10% of this net income will go to affordable housing programs. Indeed, home loan bank stockholders have already been paid $2 billion in dividends through September 30th of this year. And these payments are based on their risk-free investment in a government-sponsored enterprise that has gone way too far in just serving their financial interest. You know, as I mentioned, the home loan bank system wasn't founded yesterday, and it won't change overnight. It won't change tomorrow. So we expect that reform will be a multi-year effort. FHFA has indicated that it will start issuing rulemakings starting in the beginning of 2024. And we expect them to start with the core issue of mission, defining mission and the mission statements. There's also momentum in Congress to really tackle this issue. Last Congress, Senator Cortez Masto and Congressman Torres introduced the Home Loan Bank's Mission Implementation Act. This bill proposed to double the assessment for affordable housing programs, to create an economic development grant program, and to allow CDFIs to pledge non-housing collateral. The Cortez Masto and Torres staff are working with other members in Congress to update that bill with some of the new recommendations from the FHFA report. So this was sort of the end of my quick 20-minute primer. If you want to learn more about the new Coalition for Federal Home Loan Bank Reform, you can go to our website, you can email them directly, or follow us on social media. So I'd now like to invite, I'm going to stop the share. I'd now like to invite our two panelists to come on. And I'd love to introduce them and kind of start the panel discussion of this webinar. So first of all, Barry Ziegas. He's the former president of the National Low Income Housing Coalition, former senior vice president for community lending at Fannie Mae, and he's currently principal at Ziegas and Associates LLC and a senior fellow at the Consumer Federation of America. And Peter Knight, he's the co-founder of Policy Kinetics. He was involved of the enactment of all major banking and GSE legislation from Garant-Saint-Germain to Dodd-Frank. He has worked for federal banking agencies, for members of Congress, trade associations, Fannie Mae, and the Federal Home Loan Bank of Pittsburgh. So there's a lot of expertise in the room. So I'd welcome you to also start thinking about questions for these experts. Both have extensively interacted with federal home loan banks and with GSEs. So they both will be able to offer a unique perspective on this issue. So I'd like to start with a question for Barry. You know, you've been extensively involved with GSEs and GSE reform over the years. So can you tell us a little bit more about how the Federal Home Loan Bank as a GSE is different from the other government-sponsored enterprises, and what lesson can we take from previous GSE reform to learn about this issue? Yeah, you're muted, Barry.
Sharon, thank you very much. And thank you to everyone who's signed into the webinar. This is a really important topic that's going to be getting a lot of attention over at least the next couple of years. So thank you for your time today. Let me start by describing a few of the similarities and differences between Fannie Mae, Freddie Mac, and the Federal Home Loan Bank system, because as Sharon has pointed out, they're all GSEs. They all have federal charters that grant similar benefits. Fannie and Freddie are shareholder-owned companies, although they've been operating in conservatorship since 2008. The 11 federal home loan banks are cooperatives owned by their borrowers, as you saw in the slides. Fannie and Freddie operate by law throughout the United States. Each federal home loan bank operates only within its specific service area, although some borrowers can be members of more than one federal home loan bank. All of these entities borrow funds at favorable rates due to the implied federal guarantee of their debt, although at Fannie Mae and Freddie Mac, after 2008 and going into conservatorship, they have very minimal portfolios for which they're borrowing money. As I'll describe, their business model is quite different than the federal home loan banks. And of course, all three are regulated by the FHFA. Fannie and Freddie's activities are limited to residential mortgage finance in both homeownership and rental housing. Fannie and Freddie purchase and then bundle into securities whole mortgage loans originated by primary market lenders, guaranteeing the timely payment of principal and interest on the securities flowing from mortgagors' monthly payments. They transform illiquid individual mortgages into highly liquid securities and assume the credit risk of the underlying mortgages. Federal home loan banks, on the other hand, lend money to member banks, credit unions, CDFIs, and insurance companies. These loans are basically risk-free because of the Federal Home Loan Bank's super senior lien that puts them in front of any other creditor in the event the borrower cannot meet its obligations. Most of these loans, as we've seen, can be used by the borrower for any purpose. There are only minor requirements for ongoing mortgage or housing finance activity by the borrower as a condition of membership. Fannie Mae and Freddie Mac are subject to a range of mission-focused requirements, which were first imposed in 1993 and expanded in 2008. For instance, they have annual percent of business housing goals. They have to create, submit, and report progress on meeting specific underserved markets credit needs as defined by Congress and the FHFA. They have to create and report progress on equitable housing finance plans required by the FHFA, and they pay an annual assessment of 4.2 basis points of the prior year's total business volume to fund the Housing Trust Fund and Capital Magnet Fund. And as you saw in the chart, this amounted to more than $1 billion in 2021. The federal home loan banks are required, on the other hand, to allocate at least 10% of net earnings to the affordable housing program. As Sharon showed earlier, this has been typically a substantially smaller amount than the Fannie Freddie assessment. They are also, and is used in very, very different ways than the allocation from Fannie and Freddie, which goes directly into a government-operated program. The federal home loan banks allocate their subsidies through their members in individual projects, and as Sharon said, usually as gap filler, important but not critical. The banks are also required to operate a community investment program that provides lower cost advances for certain housing and community development activities, but there's no minimum funding requirement for the CIP, and many of the banks don't participate in that program at all. So that, in a nutshell, are the big differences between the three GSEs. I'm going to turn it back to Sharon and look forward to questions people may have on this or other topics.
Thank you, Barry. Yeah, that is super helpful to kind of get a clear, story about what the differences are. So I have a question for Peter. So Peter, you bring decades of experience with the federal home loan banks themselves as well. So my question for you is, there's always so much going on in the policy world, in Congress, and in housing policy in particular as well. So why should people care about the issue of federal home loan banks in particular?
Well, thank you, Sharon, and thank you for that great overview of the system. People should care because this is an untapped resource. The federal government doesn't create credit programs or government-sponsored enterprise just to benefit a certain industry. They do it to meet unmet credit needs. And over the years, the markets and the market needs have been changing dramatically. Home loan banks have not. As Barry was talking about the obligations of Fannie and Freddie over the years to basically support federal government directives, the home loan bank obligations over the years has actually gone much weaker, much away from home loan banks providing meaningful public support. It's not only when in 1989, the home loan banks were not only tasked with providing 10% of net income for an affordable housing program, they were tasked with providing 20% of net income to cover some of the taxpayers' debt service of savings and loan bailout bonds called REFCOR. The nature of that obligation was changed a little bit in 1999, but the thing to remember is that in 2011, the home loan banks satisfied that obligation. And because everybody was focused on Fannie and Freddie and conservatorship, and that was a massive issue. There wasn't any public attention on what's going to happen to that 20% of net income now that the home loan banks have met that obligation. So the home loan banks very quietly, with the support of the regulator at the time, diverted that 20% of net income to themselves. So that has been building up over $7 billion. 7 billion seems to be the number of the morning here, but they put $7 billion into a special class of retained earnings that really becomes an enabler of dividends being paid out of the other pot of retained earnings. So I think when you look at kind of scratching your head and wondering how can home loan banks be earning this amount of money in 2023, a big part of that is they're getting risk-free investment income from investing those retained earnings and getting a very significant return on that. But the home loan banks are cooperatives, so they're owned by their members. And this is always going to be a challenge. And this has been noted in many reports, including former Fed Governor Dan Tarullo's report on the home loan banks, which said, you put private sector interests managing a government-supported corporation, and it has a danger of diverting too much of the value within the cooperative. Now, I think the vast majority of home loan bank board members who are really running these banks are working out of the really sense of public service and duty, but they're also feel they have a fiduciary responsibility to their members, to the stockholders. So there's really no voice for the broader public to get engaged with home loan banks on how those benefits are distributed. And it's just tremendous that the finance agency has spent this time to do an amazing review with, everywhere from Guam to Puerto Rico with listening sessions and really trying to bring more people into the conversation than just simply the owners of these cooperatives. And the finance agency in this report, and I think, people should go to the coalition website for more information on what's in this report. But really the report says, look, we're trying to get a better balance between the relative value between the cooperative owners and the broader public. So, you'll hear the home loan banks talk about the value proposition, and they're talking about the value to the members. I think people on this call should think about what's the value proposition to the public here, and that's really sort of the central issue.
Great, thank you, Peter. Yeah, I think that idea of the value proposition of the sort of public benefit versus the private benefits that's being provided here is a key question. So yeah, the FHFA report included more than a dozen recommendations for extensive reform of the system, some of which they will pursue themselves through rulemakings, others of which will require congressional action. So my question to Peter and Barry, so if you could only change two things, so you could start with changing two things about the home loan banks as they currently are, where would you start, or what's your top two of priorities? So I think we'll start with Peter again. Yeah.
Well, thank you. And that's a good question. And having watched a lot of the listening sessions, the videos and transcripts of all these listening sessions that the finance agency conducted are available on their website. They sort of wanted to hear the same exact answer to that question. What are the top two things that people would want to see out of home loan bank reform? When I look at the report, and the thing I think is just stunningly important is this definition of mission. There really has been no definition of mission in the statute. It's very vague, and I know the home loan banks tried to get a explicit definition in statute during the development of ERA in 2008. The Congress wasn't willing to do that, so it's vague. And so it's kind of become a situation where the home loan banks have been able to self-define their mission. And so the finance agency report I view it as a roadmap, and it lays out the foundation of having a mission that shows affordable housing and community development is at the heart of that mission. And then it builds out and says, we're going to issue a regulation to require home loan bank boards to take on as their duty to foster an accomplishment of this new mission. It's going to reward home loan bank members that are more focused on mission activities, reward members that put mission-related collateral up for advances, and a whole range of things. So I think, Sharon, my answer would be the top two things for me are mission and mission.
Great answer. Barry, do you want to add to this?
Thanks, Sharon, and thanks, Peter. That was excellent. I would certainly agree that defining the mission is the most important task that the agency should face. But I want to clarify, that all of us involved in this coalition are focused on this, not because we think there's the federal home loan banks should be abolished or that their mission isn't important. It's that they're too important not to be functioning at the highest possible level to deliver good value to the American taxpayer. So I would say, since Peter's taken two for mission, I'll just endorse that, but also say increasing the contributions for affordable housing, the cash contributions for affordable housing, as is recommended in the report, is critical. Recently, at a Senate Banking Committee hearing, 5 of the largest bank executives from 5 of the largest banks, who are all members of the home loan bank system, said that would be fine with them. They were asked and nobody objected. So I don't think that's a heavy lift. And a strong argument can be made that 20% is the minimum, and an increase to even 30% would not be out of line. So that's number one. Increase the amount of actual revenue, profit from this system back into the purposes for which the system was originally chartered. And I'd say the second thing is to direct the institutions to more aggressively use this retained earnings portfolio, their portfolio opportunities, to play a much bigger role in breaking new ground in mortgage finance liquidity. There's a host of what I would call orphan programs, orphan mortgages, whether they're on tribal lands, whether they're small dollar mortgages, whether they're small multifamily mortgages, that are very hard to finance through the commoditized national system that Fannie Mae and Freddie Mac run. Not a criticism, just an observation. The federal home loan banks, on the other hand, because they're in 11 different regions, because their members are the institutions that have the possibility of making these loans, can be much more aggressive in offering favorable terms, lower rates, and other advantages to encourage liquidity in parts of the market that are not well served by Fannie Mae and Freddie Mac, who are providing liquidity to the vast majority of mortgage transactions. So it's a unique opportunity, and one that the banks are uniquely structured to be able to serve. So I would say that would be my number two. Expand their integration and influence in making mortgage credit available to more underserved markets than is presently the case.
Great. So my next question is, in order to pass, some of this needs to be passed through Congress, right? So in order to do that, we need people from both sides of the aisle to support it. So question for both of you. Can you speak a little bit more on how home loan bank reform is a bipartisan issue, and why should both Republicans and Democrats in Congress care about this?
I would start by saying that housing availability and housing affordability is a bipartisan issue, and it's something that affects the constituencies of every single elected member of Congress in the House and the Senate. So finding ways to help reduce the barriers to affordable home ownership and affordable rental housing is a critical need that all members should be supporting. That's number one. Number two, both parties have fully embraced the idea that as much as possible, we should leverage the private sector to help meet public goals rather than impose upon the taxpayer new burdens. And the federal home loan bank system is ideally suited to that very purpose. And as I said before, the home loan bank system can actually drill into markets that are not well served by big banks on the coasts or national financial institutions to help move issues like lending on tribal lands, which is desperately needed, or lending in markets where small balance loans, small mortgages are really the most important resource to bring into underserved areas. So I think there's a lot of bipartisan opportunity here to come together to take this institution with a long and storied history and one that we all support, but want to see directed more effectively to meet these needs. And I'm optimistic that we can find that ground. Now, whether Congress can find its way to do anything bipartisan, anything productive in the near term is a bigger question for political scientists and commentators than we have on the call today. But I see big opportunity for this. And one of the lessons of GSE reform after conservatorship went into place in 2008 is that it is possible to come together on the larger frame of what GSE should be used for. But I also say one of the lessons we learned is you have to keep a focus on this mission question. And how is the GSE going to be used, not just to provide safety, liquidity in the broad sense, safety and stability in the financial markets, very important objectives, but also how is that going to be used to ensure fair and equitable access to mortgage finance, both in terms of the different kinds of housing that's being invested in, about advancing racial equity and reducing the home ownership gap between white households and the households of color, and one of the preeminent challenges of our time. So I think there's a lot of opportunity here, and this focus on mission has got to be the key driver of that conversation.
And Barry, I would add to that, and Sharon, I didn't write all those bills. I was involved in them, and one of the things that quite often happens with major policy legislation is a lot of times it's a little behind what's going on in the market, and it ends up adopting what in fact is already going on. I would say that all members of Congress should appreciate what the finance agency is doing, and should also understand that the finance agency is essentially it's a steward of the public interest, and also first and foremost a safety and soundness regulator. So there should be some level of comfort there. When you look at low-income housing tax credits, which is the largest federal program to support the construction of affordable rental housing, you look who votes for that, it's wildly bipartisan, broad support. I think this same approach, as Barry mentioned, should come to federal home loan bank reform, and should also then be, as people view what the finance agency is doing through promulgating regulations, should keep that in mind and should engage and participate. I think two things in particular is rural economic development and development in small towns. I know many members of Congress and senators, their overabiding concern is how am I going to help the small communities in my district or my state survive and thrive? And the home loan banks are ideally suited to provide tools and resources to their small banks in these small communities. And they are going to have to think about that, and they're going to have to work at that. And they can have such a huge impact. And I think also something that really hasn't gotten much attention is community banks. The community banks are always sort of first to stand up and defend the home loan bank system to charges. And that's great, because community banks are really, really dependent on home loan banks. But I think the community banks should be looking at this reform process, and this is certainly a bipartisan issue, and sort of start with a blank piece of paper and think about what could the home loan bank, my home loan bank, do to provide me more products and services so I can better serve my community. That doesn't always mean the home loan bank's going to be giving a check to that bank to disperse in the community, but it means that they would be developing turnkey programs that these community banks could deploy. They're the boots on the ground for the home loan bank system, and sort of one of the really wonderful elements of that. So I'd say, rural economic development, small community development, and community bank support will all be benefited as this process goes forward, but it requires that everybody sort of participate in this discussion, whether it's through the Coalition for Federal Home Loan Bank Reform or through their organization, and basically use this opportunity, because we're dealing with a blank slate here. Everybody has an opportunity to pick up that chalk and write the future, chart the future that will help them achieve with their individual missions.
Great. Thank you, Peter. Yeah, I also appreciate your kind of reminder that, we're dealing with a system of 11 regional banks, right? So they all kind of serve different parts of the country. So this brings me to my next question. We have congressional staffers in the audience as well. So where can congressional staff look to learn more about the Federal Home Loan Bank that serves their state, and what can they do to kind of press their regional home loan bank, I guess, to make changes?
Well, I could go first on that because I think it's really important. We talk about a home loan bank system, but obviously it's 11 independently operated regional cooperatives. When you look at the numbers on the voluntary programs, that's stunning. The fact that certainly Pittsburgh just about hit the home loan bank system-wide promise of going 5% above the 10% for the affordable housing, but none of the other banks came close, and one of the very largest banks was zero. So, if you look at that chart, the congressional staff look at that chart and then look at the map of the home loan bank system and engage that all the home loan banks have government relations people that work very hard at informing the Congress. And so it's an opportunity. I would also, anybody on the call with any organization or anybody who's interested in housing and community development in their area, look at the home loan bank individual website, look at the boards of directors, and reach out and start contacting those boards of directors and say, I'd really like to see your bank do this or that or do more. And they will listen, and they'll take it to their board meetings, and they'll pass it on to senior management. So there are a number of things that really the home loan banks have really is tactically, strategically just tried to keep their heads down. Just stay in the foxhole. Don't draw attention to yourself. Well, the attention is on them now, but it really can't happen in a vacuum. So that's a great question.
I'd also say that every bank has a community advisory board. That's a requirement from the 1989 legislation. Find out who's on those councils. If you're interested in this work and you're in one of the districts and you're interested in this issue, consider trying to get on the council. Those councils are influential bodies that advise the home loan banks in each district. And I'd say that's another way in for all of them. And finally, if people haven't read the FHFA report, Federal Home Loan Bank System at 100, I urge you to do so. It's a terrific report. It's very thoughtful and very thorough, and takes a very even-handed but firm approach to some of the issues that the home loan banks need to confront.
Great, thank you so much, Barry. I'm about to turn to questions from the audience. So if you have a burning question, this is your chance to ask two national experts on this issue. But before I do that, I will ask my own final question to Barry and Peter. My question is, in your view, what's the most misunderstood fact about the home loan bank system that you would love to clear up today in this webinar?
That they are a federal home loan bank system and play a major role in the liquidity of the housing finance system. That's just not true. That's documented in the FHFA report. They certainly play a huge role in providing liquidity to member banks, but often that's at the expense of deposits. They're drawn down when deposits may shrink. They're used as a balance sheet mechanism, a balancing mechanism by these institutions, not necessarily to forward real work on housing and community development.
I think my comment would be kick the tires a little bit on the information you hear from the home loan banks, and hopefully this will change. But the home loan banks have largely been taking an approach that everything's perfect. Don't touch it, and if you do touch it, you'll destroy community banking. You'll increase interest rates on everybody's mortgage, and those kind of scare tactics that really need to be examined. And I just think, I would hope that the home loan banks do embrace this whole process as in the long-term best interest of the home loan banks, the home loan bank system. Great,
thank you. So one of the questions from the audience is, it says, as suggested by Director Thompson's FHFA report, wouldn't shrinking the number of federal home loan banks work against getting to the smaller and needier borrowers?
I think when you look at the The biggest merger, I think maybe the only merger that happened about 12 years ago or so, was Des Moines and Seattle. And that was done because Seattle was failing and they had to work. So then you have a very large 13 state district. So that's a very good question. I mean, there is a test case on that. But many of the home loan banks, the home loan bank system was created in 1932. So as the Congress sort of used the Federal Reserve Bank system as a template for the home loan bank system, and they said, okay, let's just divide up the U.S. economy, 1932, into 12 districts. So you had some districts that were very large. Atlanta, for instance, I think has 7 or 8 very big states now, but in 1932 they weren't. So some of this are only 2 states. So I think you have to look at it a case-by-case basis. But the other thing I think, when you're looking at banking mergers, you know, the federal regulators are required to examine banking mergers and look at service to communities as part of the, you know, bank regulatory requirements for big mergers. There should be an eye to home loan bank mergers, which just simply isn't, you know, the numbers of these are the expenses and this is, you know, the earnings and this is things of that nature. Should be, take a look back at the Seattle Des Moines merger. You know, would some of those states are better served? Certainly they're served by a healthier home loan bank, but some of the other issues of, you know, what will be the service? It's a case-by-case basis, Sharon.
Yeah, no, great
Yes,
answer.
I would just add to that, and the fact that, you know, there's nothing magic about 11. And one of the real questions that answers this question that the agency has put forward is the current configuration the most efficient? Another issue they raise is, what would be the outcome? What would it look like if banks created what they call centers of excellence to specialize, right, for the system in specific areas of investment? This has happened with the mutual mortgage purchase program that basically operated by the Federal Home Loan Bank of Chicago on behalf of all of the banks, because they have they develop the expertise to run a secondary mortgage market program within the bank system. So again, you don't necessarily have to shrink the number of banks, but you could grow some of the bank's expertise on behalf of the system and not try to have to duplicate it in every district or have inconsistent application of different rules depending on where you're located.
Great. This question is for Peter. Reverend Cortez recommended allocating the interest on the retained earnings to community development to a community development fund to guarantee CDFI loans or unmet mortgage needs, such as land trust, tribal loans, or ADUs. Can you explain this proposal?
Yes, so I do work for Esperanza and Reverend Cortez, and I know he's sorry he couldn't be on this, and he served for 20 years on the board of the Federal Home Loan Bank of Pittsburgh. So trying to figure out ways that the home loan banks could increase their financial support of housing without damaging their capital, without increasing risk to their low-risk business model. We came up with a proposal that this $7 billion of restricted retained earnings, which is generating and throwing off a lot of income for the banks, which they can pay 100% of that income out in dividends or whatever they choose to do, could be applied to affordable housing. And then when we looked at that even further is, well, what would be the biggest impact on that? So Home Loan Bank Affordable Housing Program, I think as Barry mentioned earlier, is maybe 5.5% of the funding needed for these affordable housing projects. And so they're not, you know, they're not that impactful in terms of, is a project going to go or not? But taking that income that could be generated from the restricted retained earnings and applying it in creative ways using credit support, credit enhancement, loan loss reserves, a number of ways to take those that financial support and multiply it and use it. Barry mentioned small rental, or Sharon, you did a small rental under 49 units. There's a huge amount of rental housing, and Esperanza is trying to do this in North Philly, but this would work across the country in rural tribal areas and the like. So what it does is require creativity and effort to try and come up with ways to do it. But to hear, one home loan bank representative at the opening listening session said, every increased dollar for AHP is coming out of dividends. And that kind of says it all. H.L. Mencken said, when they say it's not about the money, it's about the money. And I think from those advocates for reform and doing more for affordable housing, I'd agree with H.L. Mencken on that. So, but there are ways to do it in ways that I know the finance agency is not going to support anything that causes greater risk on the balance sheet of the home loan banks. I think this is something I'd encourage people to look at creative ways. And this is one that would double the affordable housing right away from the 10% without changing the capital, wouldn't impact the home loan bank's ability to pay dividends. And if they felt they couldn't use this income from the restricted retained earnings, they could tell the regulator, well, we're not strong enough to be able to do that right now. So sure, the regulator would understand and give them a break. They'd have to make that assertion.
Yeah, so this is I just add Peter's comments excellent, and this does get back to my suggestion that the banks could play a bigger role in moving into underserved parts of the market. Another distinction between the banks and Fannie and Freddie is they have portfolios. They invest money. Fannie and Freddie no longer have portfolios. At one time, it was suggested that that was a role their portfolios could play. Whether they did or not is a matter of argument, but it's history now. But the banks do have portfolios that they can invest. Another difference is Fannie and Freddie have a mandate in their charter to lead the market in mortgage financing, by which was meant to help lead primary market institutions into new parts of the market by providing liquidity for mortgages that might otherwise not have it. And that's a role that can and should be assigned to the federal home loan banks as well, and would help this kind of work that the commenter asked about.
Great. So next question. As mortgage lending has moved more to non-bank financial institutions, how might these institutions become involved? Should they, I guess the question is, should they become involved with the Federal Home Loan Bank? I don't know who wants to take this.
Yeah, well, I'll start. I mean, yes, it's true. The vast majority of mortgage lending is now done by independent mortgage banks, which do not take deposits, don't typically have balance sheets, and operate as an intermediator between consumers and the secondary mortgage markets. They are not allowed to be home loan bankers because they don't meet the requirements of being a supervised depository like the other members. I think this question is an important question. FHFA is clearly teeing it up as part of this report. It will be part of the public conversation. I think the question has to be asked is, to what purpose? These independent mortgage banks today have access to global capital through Fannie Mae and Freddie Mac. The system has shifted substantially since 1932. And so we have to start with what unmet need, what purpose would membership in the Federal Home Loan Bank system mean for these institutions, and what would be the justification for them joining the system when they already have a substantial access to access to mortgage financing through the GSEs, the other GSEs, Fannie Mae and Freddie Mac. But it's a legitimate question and highlights the fact that a system that was started to provide liquidity for home finance has largely been overrun by changes in the mortgage banking system over the last 50 years.
And I would just say right now, the mortgage bankers, the non-bank originators of mortgages are 80% market share. So from that sense, they really should be part of this system. What do they need home loan bank membership for? Probably for funding their warehouse lines of credit, because they'll get a cheaper rate on that. It'll be a more regular sort of source of funding. But the problem with independent mortgage banks, and this has been raised by Ginnie Mae, as well as FHA, is they're not prudentially regulated. They don't have capital requirements. They don't have liquidity requirements. And so if independent mortgage banks and non-banks were to be allowed into the home loan bank system without any of that prudential supervision or requirements, it would put at risk, I think, the capital of the existing stockholders. So there are ways that independent mortgage banks could propose to come into the home loan bank system, but they really haven't engaged it seriously, because they would have to basically create a de facto prudential regulator to be doing the work that the bank regulators do for them. And I mean, one idea would be maybe get a big reinsurance company to insure the risk to the home loan bank, that independent mortgage bank failing. And that would have the nice effect of the reinsurance company who's taking all that risk would be the de facto regulator. I mean, that's one idea. Maybe it wouldn't work. It would certainly eat into the profitability of a mortgage banker trying to access those funds. And there are a lot of ways. I haven't seen anything come out of the mortgage bankers to lay out how they would address those concerns. It was the topic of one of the roundtables, finance agency, and I know, as Barry mentioned, they're interested in this, but it'll be a lot of work.
Well, who wouldn't want access to cheap money? Again, let's be clear. The model of the independent mortgage banks is to originate and sell a product to the secondary market. Not Fannie Mae and Freddie Mac do not invest in these companies. So they are looking at the credit quality of the product that these entities produce and their ability to service the loans. FHFA, I mean, the Federal Home Loan Bank System, would be necessarily looking at their ability to repay advances, which raises all of the very difficult issues that Peter has raised. So it's not a simple question.
Yeah, thank you. We're starting to run out of time, so I'm going to ask one more question. I'm sorry that we cannot get to all the questions today, but you know, it sounds like we need to ongoing. Maybe we'll do a future webinar. That sounds like it's great to see that there's so many questions. So this question is a range of questions. So the question is, what salaries are paid to the Federal Home Loan Bank's presidents? What compensation is paid to Federal Home Loan Bank board members? And then how do people become board members of Federal Home Loan Bank?
Well, just very quickly, the board members are elected by the other members in that state. 60% of the board members are elected by their director members. And so if you're a bank in Iowa, you're going to be elected by those stockholder banks in Iowa. And they get compensated around $100,000 a year. Home Loan Bank presidents probably make between $2 and $3 million a year when you add in, you know, the whole package.
Yeah, good to know. Maybe we should all become board members.
Well, Peter, there are independent board. You should just make a point. There are independent board members in each district as well. You might say a word about how people can get on that.
Absolutely. My client, Reverend Cortez, was an independent board member. The statute requires 40% of the board to be represented by independent directors. That slate of independent directors is put forward by the boards of directors, and those are elected district-wide. And I think typically the boards look very hard to make sure a lot of the skills that the board may be lacking are met in that, and that might deal with accounting or IT, you know, capital markets and things that community banks, who are most of the board members, director members, might not have those skill sets. But then the statute requires at least 2 of those independent directors be community interest directors with special expertise in consumer finance or particularly affordable housing. So it is a minority of the board, but that's how people get to be on the boards.
Great. So I would like to thank our panelists for today, and thank you everyone for your engagement and your questions. Really appreciate it. Both the Consumer Federation of America and the Coalition for Federal Home Loan Bank Reform would love to stay engaged with you all on this issue. And yeah, keep an eye out for future webinars and future content.
And Sharon, who should our listeners reach out to if they'd like to join the coalition and become part of this work?
I think they should go to the website, the Coalition for Federal Home Loan Bank Reform, and they can. There's a sign up, become a member link on the website. Katie just posted it in the chat. federalhomeloanbankreform.org. So, all right, thank you everyone, and have a great rest of your week. Yeah.
Thank you. Thank you all the people who joined.
Thank you.